Hi, welcome to this month's ATV Tax Tips. This month we're going to look at the tax implications of providing additional benefits alongside the remuneration package offered to staff. Often in terms of trying to retain or attract new talent, employers are looking at more and more benefits to add on to the package to make it as attractive as possible. So the first thing we're going to look at, mobile phones. The provision of a mobile phone, if an employer takes a contract out and provides an employee with a mobile phone, is not a taxable benefit. So if that employee has the company mobile phone and they use it for business but also use it for private calls, there's no restriction or no requirement to record the level of private use compared to business use. They're allowed to use it in whatever proportion they see fit or you see fit as an employer. And as long as the employer has the contract in their name and is paying for it in full, then no taxable benefit arises. Issues can arise where the employee has the mobile phone contract and asks the employer to reimburse them for the cost of it. In that case, where there's private calls, a taxable benefit can arise on the reimbursement of the private calls. And so what should happen in those scenarios is that the employee should get an itemized bill, highlight the business calls that they've made, and then ask the employer to reimburse them just for the business calls. Bit of an administrative nightmare. And so really, from both a simplicity point of view and a tax efficiency point of view, the best thing is for the employer to take the mobile phone contract and give it to the employee. Second benefit that's available to offer is the Cycle to Work scheme. Now, we cover that in great detail on episode 8 of Ascentis TV back in August last year. So if you want any more details on that, the best thing to do is go to our YouTube channel and look up episode 8. Another option that we're being asked about quite a lot recently, actually, is free or subsidised meals within the workplace. Now, that could take the form of a working lunch or perhaps just offering free food, say on a Friday, at breakfast time. To cover the working lunch first, to be honest, to cover all food, really the main thrust of tax positioning on this is that all employees must have the opportunity to obtain the benefit of the food. So if you are offering a working lunch, then as long as all the staff within the meeting are able to take the opportunity of free food with the meeting, and as long as you don't segregate certain meetings that can have free food and certain ones that can't because of who attends, i.e. all your directors' meetings have free food and all your staff meetings don't, then you're okay from a tax point of view. It's not a taxable benefit to provide food in those scenarios. Similarly to offering, breakfast food or similar perhaps on a Friday, as long as you offer food to an entire staff base and nobody's excluded, then again, it should be an exempt benefit and no taxable benefit arises. On a wider scope of staff entertainment and providing entertainment to your staff, then we've talked before about the fact that for an event, perhaps a summer barbecue or a Christmas function, then you can spend £150 per head, including VAT, on a function and no taxable benefit arises. Now, if you have more than one function, let's say you have a summer barbecue and a Christmas party, then the £150 per head is for the entire tax year. So both functions must fall within that limit of £150 per head. As soon as you go over £150, the whole event becomes a taxable event, effectively, from an income tax point of view. And so it's not sort of an allowance; it's an exempt limit. So if you've got two parties, one that costs say £100 per head, and the other that costs £60 per head, then your £100 one would be exempt, but your £60 one would potentially be a taxable benefit on the staff. Now, the point of that is that potentially you're going to have to add the cost of your function to a P11D and get all your staff to pay tax and national insurance on the provision of that benefit, which is probably something that they're not going to be keen to hear. So coming on to potential ways to mitigate that circumstance. First of all, another way of incentivizing staff is through non-cash vouchers. So staff can receive non-cash vouchers up to the value of £50 per voucher. As long as they're not in return for services, then they're not a taxable benefit. So the real thrust of this is to offer the opportunity for employers to give staff a present, perhaps on a special occasion, perhaps a birthday or a wedding anniversary or something of that nature, up to the value of £50, often, a bunch of flowers or something like that. The non-cash voucher also extends to any non-cash benefit. So if you go out for, say, Friday drinks where the staff are, you pay for maybe one or two drinks, as long as the cost of those drinks doesn't exceed £50 a head, then again, you're going to fall into this regime where no taxable benefit arises. Coming back to our situation where we were talking about before, where perhaps you have a lavish Christmas party or a lavish event where you well exceed the £150 a head limit, and you don't want your staff to pay tax on this, but you still want to go ahead with the event, then you can arrange to set up what's called a PSA settlement agreement with HMRC. The benefit of this is that it avoids the need for the employees to pay the tax on the benefit that you're providing. The downside, if you're an employer, is that you pay the tax. So what happens is a calculation is done to work out the marginal rate of tax that would have been payable by each member of staff. The tax and national insurance is calculated on the benefit provided, and as an employer, you pick that up and pay it over to HMRC. You have to agree what is going to be included in a PSA settlement agreement when you approach HMRC to do this. For example, staff functions can be included, or expensive gifts. If, for example, you want to spend more than £50 a head on gifts at Christmas, then you could include gifts of that nature in the agreement. So this month's quick tax tip relates to auto-enrolment pension schemes. Now, back when automatic enrolment was introduced, many employers went out and set up a pension scheme for the first time. Some took advice, some didn't. And most automatic enrolment pension schemes are currently operating in a way that isn't particularly tax efficient. We saw recently that the government raised not only employee national insurance by 1.25%, but also employer national insurance by 1.25%, effectively increasing the tax cost of employing people. If you've got an automatic enrolment pension scheme, you can have that set to operate on a salary sacrifice basis, which means that the pension contributions are deducted from an employee's pay before the calculation of tax and national insurance. If you do that, then obviously both an employee and an employer are going to save tax and national insurance on the pension contributions being made into the auto-enrolment pension scheme.